Good morning. My name is Gad Lebanon and I'm Chief Economist North America here at the Conference Board. And welcome to our October edition of Economics Watch. We have a full house today. I think a especially interesting program ahead of us. One of the things that, as usual, we'll talk about global and US outlook, and in particular we'll try to find out why the rest of the world is slowing down while the US economy is still going strong. The main special topic for today is the non-traditional workers. There has been a lot of discussion in recent years about the growing share of non-traditional workers excuse me, in the US and other countries. We're going to find out if that's indeed been the case. I'm going to keep you on your toes, and in slide 22, we're going to tell you the answer to that. We'll also do some comparisons between the US and Europe. In particular, we'll focus on the online labor platforms and what they are and what their potential is. As usual, you can get CPE credits if you stay there full time. You need to type your full name and email address in the space provided. There will be 3 pop-ups, so please click OK on them during the program. You need to stay online for the entire webcast, and the credits are available for live participation only. So we have a full roster today. First, let me introduce you to our speakers and guests. First on my right, Ilaria Maselli, Senior Economist for Europe, who's usually she is joining us from Brussels, and today we have the pleasure of having her in our studio. Welcome, Ilaria.
Thank you, Gad, and hello everyone. I'm so happy to be sitting here with you guys this time, not alone in the Brussels studio.
Good. And we have in our Washington office, or more accurately in Elizabeth's home, we have Elizabeth Crowfoot, a senior economist at the Conference Board. Welcome, Elizabeth.
Good morning, everyone. Thanks.
And as usual, my guest and sometimes the host, Brian Shaitkin, also senior economist at the Conference Board. Welcome, Brian.
Thank you, Gad, and happy to have Ilaria in the studio and to be in the brave new world of 3.2% interest rates. We'll talk about that.
Yeah. Good. So as usual, we're going to start with the global outlook. And Ilaria, why don't you tell us what's happening outside of this country?
All right. Thank you, Gad. Yes, let's get started. What you can see here I will start with the usual. So if we want to know what's ahead in the economy, we have to look at the LEI. What you can see in these charts on the blue line is the global LEI, the annual percentage change. And then there are 2 lines. The gray line is emerging market and the yellow line is mature economies. So the first message that comes from the chart is, of course, that the global economy is still in a very good position. You can see that there's been incredible growth over 2016 and 17 and 18. But now this growth is somewhat moderating. And you can see that from the latest data point of the blue line. But I think that the global view stops here in the sense that we really have to make a distinction then between emerging markets and mature economies. So let me start with the latter. For mature economies, again, we have a dividing line between the US, where, as you said, the economy is doing really well. It's very strong, and we will come back to that in all details later. And then there is the euro area, where the economy is also still quite strong. But you can see that 2018 is not the same as 2017. And looking ahead, this moderation is expected to continue a little bit. And then there is the UK, which has a completely different weight, completely different picture in this in here, because The UK is actually, among all the countries for which we monitor leading economic indicators, is the one where there is the only one where there is actually a strong recession signal. So that, of course, has a weight into the flattening, I would say, of the yellow line in this chart. And then there is the emerging markets. As you can see, also growth in emerging markets has been quite strong, and the economy is still actually quite strong. But we have reached a phase in the cycle where the risks are starting to become more visible and more concerning. So I will perhaps go to the next slide because I can give you some more details on that. So where do I start? Maybe I can start with a country where the outlook is all in all very, very positive, and that's India. Despite the fact that oil prices are rising and India is an oil importer, the economy seems still very strong, largely driven by domestic consumption. But then the bright part of emerging market is over, so I have less good news for other countries. One thing that is important, I think, in this stage, and that became visible in the last couple of months, is the fact that trade, the trade tension, of course, has an important weight in the outlook, and you can see that the decline in global export and import is, of course, a concern for emerging markets. Now, at the same time this is happening, currencies are devaluating in reaction to that, but this doesn't seem to benefit the economy yet. We should see that in the next few months. Then there is the other important component of oil prices increases at the same time as currencies getting weaker, and that creates tension when you look at the current account. So whenever there is a problem in emerging markets, the first indicator you look at is the current account deficit, because you start to question when at a certain point whether they're able to pay back this debt and these payments. So that's where I think we will spend more time in the next months looking at how this continues with the trade, devaluations, and current account sustainability.
I just read yesterday that IMF came with the new projections, and their estimated impact of the trade wars on global growth was surprisingly strong. Ilaria, Brian, any thoughts on when and how big this impact will be?
It's difficult to put a number to that. I mean, because it's good to have a model, to try to have an idea, as the IMF did. There was also a recent paper by the European Central Bank that tried to do the same for to see the impact on China and US and Europe. And they also show that the impact is quite strong. I think we are moving towards a new phase of the trade tensions, because at the beginning the impact was very localized, it was very limited, and it was very much a concern of specific industries, specific companies. So all in all, the impact up until now basically was not very strong on the economy as a whole. But as the tariffs become larger and they apply to more sectors of the economy, maybe that could be the shifting factor that bring us to a review, to reconsider again what would be the overall impact on the economy.
And I think Ilaria's point about reconsideration is well taken, because that's really what the IMF projection relies on. We've seen other projections by economists like Paul Krugman, who forecast that even if some of the most severe, some of the more expansive tariff policies are enacted by the US government towards China and China retaliates, that the impact will be considerably stronger. The difference in the IMF models is that they're making two assumptions. Number one, they're making an assumption that the US will be applying auto tariffs in a very broad way. And number two, they're making an assumption that business confidence and markets will react quite strongly to an expansion beyond the current sets of tariffs. And the key thing to recognize is that already markets believe that there is a substantial possibility that the U.S. will end up placing a very large tariff on all Chinese goods, and markets have still been doing quite well. So the question is, at what point does that market reconsideration occur, or will it occur? Will it just be a situation where, because of the overall strength of the U.S. economy, because of the fact that you have a new trade agreement that we'll talk about later between the U.S., Canada, and Mexico, that markets are not as concerned in the short term about the impact of new tariffs on U.S.-China trade?
Okay.
I think if I can add one thing, it's of course an interesting debate, so we should not take the entire hour on this, but maybe one last consideration is that we should not, one mistake that many people did in the last year was to think that the growth of export and import was back and was there to stay. It would get stronger and stronger to the levels that we observed before the financial crisis, and this was a very strong engine of global growth. And what we argued in early this year in a report that we wrote together with other colleagues is that that is not the case. All of the conditions that led to this very, very strong growth of import and export before 2008 are not there anymore. And so going down, tariffs or no tariffs, actually trade is not expected to grow anymore. So we should not rely that much on it as an engine of growth.
Before you go to your next slide, Ilaria, I just wanted to ask, you mentioned the UK, and I know we've been monitoring in the Economics Watch this country in previous webcasts. So I know you have you had an op-ed in the Financial Times. Congratulations on that. So can you share some of your thoughts on that, and in particular any updates of the past month since our last webcast? The main thing I remember from the coverage of the UK is the Prime Minister dancing again in national TV, but besides that, was there any other major developments?
Well, thank you, Gad. She was not the only one dancing, because the numbers, if you look at unemployment or GDP numbers in the UK, they're actually quite good. So there is a lot of people that believe that the economy is doing fantastic and there is no risk down the road. And basically what I argued in that piece, and that's what I've been saying actually since this summer basically, is that the risk of recession in the UK is very strong, and that's been signaled really clearly in the leading economic indicator. And what it shows, well, it has been growing negatively, going down for 16 months in a row. And this downward trend is actually quite widespread because it's driven by consumption, consumer confidence going down. It's driven down by housing market. It's driven down by stock prices. So it's actually quite widespread negative sentiment. So that's the red line going down started to be since this summer quite alarming. But then on top of it, you put Brexit and the fact that there is a massive uncertainty. We're less than 6 months from March 29 Brexit date, and there is still all the options basically are open. There could be still a referendum. There could be no trade agreement. There could be a trade agreement, and the uncertainty more than 2 years since the referendum and 6 months from Brexit is actually very, very high. And that could be the trigger of a recession.
Okay, thank you. So there are also, as we can see in the next slide, some cost concerns in growing in Europe.
Yes, that's correct. That was what we're flagging this month in the European Economic View, and in the video that you can see on YouTube this afternoon. That's, I think, the big message from this month. That all in all, as I said, the euro economy is doing quite well, even though you can feel the impact of export not contributing in the same way as in 2017. But still, the current growth and what we expect next year is still very much above the potential, which is really a reminder that the problem with the European growth is not where we are now, is actually in a good place, but it's really the potential of the economy for the next decade. And we will come back to that because we will release our numbers next month for growth in the next decade. But so as I said, we're in a good position, but the growth is losing steam, and I think in this stage it becomes important for companies to keep an eye on their costs more than ever, because costs, on the other hand, are on a rising trend. And I put here two charts just to give you an idea of the figures. You can see here wages in the manufacturing sector. So the last quarter wage growth was 4.5%, which is higher than what we observed in the past quarters. And we've been discussing this a lot. I mean, we've been saying like, okay, unemployment is going down. Why aren't wages going up? And we argued in the past months that they would go up, and finally they are going up, which is great for the economy. But of course, for companies, this is something to keep an eye on, especially because this is manufacturing sector. I would say it's the export sector, the more exposed sector to competition, and we know trade is now going down, so there will be more competition in that field. And then I put also one slide on energy prices, just to give you an idea. Energy today is twice as more expensive than 2 years ago, and that's quite a rise in steep. And just as a reminder, in the euro area, 60% of energy is imported. So that's something that is completely out of control. So this is why I wanted to mention this. Keep an eye on costs.
Okay, great. Thanks, Hilaria. So we're moving to the US, and here the news is better. We had, while the rest of the world is gradually slowing down, in the US we're probably at the fastest growth rate that we've been in several years, and it's a combination of, a lot of it is a result of very strong growth in confidence, or high level of confidence, both consumer confidence and business confidence. It's partly a result of the stimulus, the government stimulus to the economy, the tax cuts, and the additional government spending that are in a very large amount of money is thrown into the economy, and it has to show up somewhere. We'll talk more about it in the next several minutes. But as we look into 2019, we think that the environment for where companies operate in is going to be more difficult. We'll probably see some slowdown in revenue growth, because the stimulus will kind of reach its maximum probably around now, and in 2019 it will have less of an impact. Partly also we're just simply going back to trend. We are now growing at about 3.5%. The trend of the US economy is probably 2%, so there's only so many years that we can grow above trend, and we're probably going to make our way towards the trend. The Federal Reserve is also aware of that, and they're raising rates, so financial costs for companies will rise. Labor markets are tightening, and we're seeing some acceleration in labor costs. We're also, it's hard to tell about trade, but this is certainly a risk that could have a strong impact, as discussed before, unless all of this is just an attempt to solve problems before the midterm elections. So then, if that's the case, then it won't have much impact in 2019. And as we discussed before, the US is also impacted by what's happening outside the United States, and the period of very strong growth outside the United States seems to be over, and that will have an impact on the US economy. So Brian, what are some of the details around this overview?
So the place to start, Gad, is with confidence. Consumer confidence is sky high right now. It's at its highest level in nearly 2 decades. And the reason for that is A, the condition of the labor market, that you have not only 3.7% unemployment now, the lowest since the late 60s, but you also have a situation where there's just remarkable stability in terms of job situations. You have very, very few business closings for a long period of time, and that means a stability in terms of employment that individuals haven't had in quite a while. And that, along with the tax cuts, which gave consumers more money to spend, it also gave businesses more money to spend, and the fact that you have increased federal spending, which is going to start showing up in national accounts over the next 4 quarters especially, so third quarter and fourth quarter this year, first and second quarter next year, you're going to see higher government spending, and that's going to add a couple of tenths of a point to GDP during those quarters. However, that stimulus is going to fade out. The tax cut measures will have been implemented. Firms will be experiencing more difficult conditions. And the result of that is going to be, as the labor market tightens, there's more likelihood of inflation. That's going to ultimately mean higher interest rates. And you can see some of the skepticism about how strong can business conditions remain in this chart, which shows that our measure of CEO confidence is still high. It's still in positive territory, the red line. It's still above 50. So that means CEOs expect growth to continue in terms of sales, but they're not expecting the same rate of growth to continue as they were back in early 2017 and early 2018. And the reason is not just the withdrawal of some of the stimulus measures, but also the fact that there is inflationary pressure rising from labor markets, from trade, and from oil prices. And all of those factors will combine to bring the U.S. economy back towards its 2% trend. Now, that's not a bad reading, but at the same time, it represents the idea that growth will slow down over time. So now we have a poll question dealing with the recent trade agreement that was concluded between the U.S., Canada, and Mexico.
Yeah, so the studio is putting this up. So what is the greatest effect of the transition from Nafta to the USMCA on business? So USMCA is the kind of the new Nafta. Doesn't roll off your tongue quite as easily, but perhaps this is an important difference. So there are 5 options: a move in US policy towards more restrictive trade barriers, shift from multilateral to bilateral trade agreement orientation, a more aggressive approach to securing US economic interest, new requirement that the auto industry must meet to obtain USMCA product status, and increased US access to Canadian dairy markets. So again, the question is, what is the greatest effect of the new NAFTA on businesses? So it's a pretty long question and long answer, so we'll give you a few more seconds. 5, 4, 3, 2, 1. Let's close the survey. So there are 5 potential answers, but 3/4 of you chose one, which is a more aggressive approach to securing US economic interests. Any initial thoughts on that from the studio, Brian, Ilaria?
So I think that's a sign that the members on this call believe that the U.S. achieved some of its core objectives through the USMCA negotiation, and that perhaps in future trade agreements there may be certain advantages gained that can give U.S.-based companies and U.S.-based producers certain advantages. And I think there's some truth to that, but there's also some questions about that. I'd be curious to hear what Ilaria thinks in terms of how this trade agreement shapes up and sort of how to think about what happened in the USMCA agreement in a more global perspective.
Well, I think the fact that 3/4 of respondents picked the more aggressive approach protecting U.S. interests, I think shows that there is some consistency between the policy goal that was clearly that and what is the perception of the achievement. So I think there is at least a consistency there. I think on a global perspective, this is going to have some impact because there is a lot of new elements in this in the new Nafta. I still call it the new Nafta. I have to get used to the USMCA. But there is a couple of issues on IP protection and workers' rights that are still that are quite new in this agreement, and this has been something pending in the head of policymakers for a long time. Like, how can we improve this type of protection if in mature economies, especially with trade agreements with emerging markets in the future? And they haven't been able to do it so far. Now, I'm not sure. I still have to see the details of the new Nafta to understand whether this goes in the right direction or not. But I think this is the interesting thing, and I think it will have an impact on new trade agreements. And there is many trade agreements. I mean, the European Union is extremely active. We recently in the EU have signed an agreement with Japan, which is one of these new trade agreements. But still, it's not the same because Japan and EU are countries with a very similar level of development. So concerns over workers' rights are less of a concern because it's workers with similar wage levels. But there is a lot of things going on in the trade domain, and it's now a very visible topic. So I'm sure policymakers will want to score good points on that.
Yeah. Well, I think certainly from this survey, it seems like they did score some points. It seems like to the degree that this is a representative sample of US businesses, there seems to be a satisfaction with the approach and the outcome. Brian, there's a question here. What does the trend look like in collection of tax revenues for federal and state government? Has the US economy growth brought incremental government revenue growth?
So we'll know more about that once tax revenues come in at the end of the year, what effect economic growth had on revenue growth. I think what's important to remember is that between the increase in spending and the increase in and the decrease in tax collection, it is highly likely that you are going to end up seeing deficits expand dramatically unless there's a change in fiscal policy over the next 10 years. And that's the primary impact beyond sort of improving temporary growth conditions of the tax cuts and the stimulus measures. But getting back to the new USMCA agreement, I mean, I think Ilaria is absolutely right that there are a few key features in this agreement that are unique, most notably what happened with the auto industry, which is that you have tighter rules of origin. You have now 75% rather than 62.5% of content for a car coming from the USMCA zone has to come from the USMCA zone in order for it to be given that special status. You have a higher minimum wage on a large portion of labor used to produce a vehicle, which will probably drive up wages in Mexico and also may result in some production activity coming back to the US. So you definitely have increased labor standards, at least in one industry as a result of this agreement. I think the general takeaway is that across most industries, it's not going to be a big change. And the real question is, what does this mean about the US as a trade partner going forward? Is the US going to be very, very aggressive in terms of bilateral trade negotiations? Likely. And then the question is, what does that mean in terms of the connectedness of the US economy into the global economy, and how is that going to maybe change and disrupt supply chains? So that's really the key thing to keep in mind. And then finally, on the US outlook, just two more things to consider, which is equity prices are continuing to rise in spite of all of this increased trade tension. So far markets have not been reacting substantially, but you can see that as interest rates have risen in recent weeks, there has been a bit of a stall in terms of the pace at which equity prices are rising. Oil prices too are rising, and that means higher global demand in terms of oil. That's number one. Number two, it means that the U.S. now is in a position where it's sort of neutral in terms of oil, in terms of the effects that oil prices have on the U.S. economy. Because on the one hand, you have oil producers who will increase investment in order to take advantage of these higher oil prices, but you also have consumers who are going to pay more, and that's going to be another factor driving up inflation. And you can see that right now profits are increasing, and that's part of the reason why you see this run up in terms of equity prices, especially from a domestic perspective. But the question is, as interest rates rise, as financial conditions do become more challenging, and because you can see that in the last 5-6 weeks, the 10-year rate has risen by 35 basis points. That's to near 3.25, the highest since around 2011. And the end result of that is higher costs for capital, higher for firms, higher costs on housing, already a sector that's struggling. And so where that leaves us is that firms are entering a riskier environment, a more difficult environment in terms of gaining financing, and that's going to start to affect confidence, not in a way that will dramatically change the U.S. outlook, but that will cause the U.S. to enter recession, but in a way that will result in much slower growth than we're experiencing right now.
Which is what the Fed is trying to do.
Right.
The Fed is trying to slow down the economy so it is not becoming overheated. Thank you very much, Brian. We are now, this is our forecast summary. We see that we are expecting growth in the, if you look at the top row, growth to continue to be above trend and mostly well above trend for entire 2019, but some gradual slowdown as we discussed before. Brian, any underlying details that you think would be especially interesting for our viewers?
I think there are two places to look at. Number one, residential investment. You can see that that's weak. That's in part due to those higher mortgage rates, which have seen the pass-through from the Fed policy and the 10-year rate. And that's already hurting housing industry firms. And then also the government spending. You can see that in the third and fourth quarter and the first half of next year, that's where that increased government spending is going to have its primary impact on GDP. And that's why in the second half of the year next year, GDP growth is going to be lower because the private sector is going to have to carry a lot more of the growth burden than it will have to over this quarter and the next three following it.
Yep. Very good. So we're now moving to the special topic of today's webcast, the non-traditional workers. We are about to release a report on that. So before we start talking about what's happening to non-traditional workers, it would be good to define who they are. So there are four, first of all, there are a lot of names you can call them, contingent, gig, there are a lot of names. We settled on non-traditional, and we focus on four groups of workers. The first one, independent contractors. The second, workers in the temp help industry. The third one is workers on premise that are employed by outsourcing companies. And the fourth group, which is essentially a part of the first group, are workers that are employed through labor market platforms. So that's what we mean by non-traditional workers. So setting the stage, why the topic of non-traditional workers is important. So one reason is that we are, as we discussed earlier, in a tight labor market, and we're expecting this labor market tightness to become more severe. As you see in our forecast, we're expecting strong growth through 2019, and that is resulting in labor shortages and acceleration in wages, especially among blue-collar workers. It's harder to recruit, harder to retain, and the quality of labor is also something that employers are more and more concerned about. So usually when it's harder to recruit, companies tend to turn to the non-traditional sector, either hiring independent contractors or going to agencies. So is this a viable solution right now? And that comes, and now we're in slide 22, you remember at the beginning of the webcast, I told you that that's where we'll get the answer, so it's finally arrived. On top of the tightening labor market, there's been a lot of discussion about the non-traditional workers and how their share is growing in the economy and likely to grow even faster. But the conclusion of our report is that contrary to the hype, the share of non-traditional workers has not changed dramatically in recent years, and we think that also in the foreseeable future it's not going to be much larger than it is now. And part of it is because of the tightening labor market, even though there is a growing demand for non-traditional workers. If most or many non-traditional workers would rather have a full-time regular job, and in a tight labor market they are able to achieve that, so the supply of non-traditional workers is shrinking. We also, from our studies, we discovered that most companies are not didn't seriously consider the usage of online labor market platforms, which is the new innovation in the area of non-traditional workers. They're growing, but they're still small, and especially outside of transportation, they are almost a non-entity when it comes to companies. So we haven't seen much growth, and kind of what cemented this, our conclusion, is that in 2017, after 12 years of not having a contingent worker survey in the US economy, the Bureau of Labor Statistics finally surveyed this topic again. And what you see here is that essentially the numbers haven't really changed much in the past 20 years. What we see here is the share of non-traditional workers as a percent of total US employment all the way from 1995 to 2017. And the numbers are more or less the same. Now, those are the numbers for people for which this is their main job. So there probably has been some growth in the share of non-traditional work who do it at any capacity, but there is the growth is at best very tiny.
One thing to interject on this chart, and there was a question about this, is that contrary to popular perception, there is no evidence right now that millennials are becoming more likely to take on non-traditional work relative to past generations of people of similar ages. So this is not just a situation where across the entire labor market you do not have an increase in non-traditional work. You do not have it among the group that would most likely be sort of in the popular press most considered to be embracing non-traditional work.
Right. No, that's an excellent point. Now, what are some of the reasons that are holding back the expansion of non-traditional workers? One thing that this is related to the long-run trend of outsourcing. So since for the last 4 or 5 decades, there has been a very strong growth in the share of jobs that are being outsourced by companies. So 50 years ago, janitors, cleaning people, security guards were much more likely to be directly employed by the company. Now they're more likely to be employed by an outsourcing company. So the trend, but what we've seen in recent years, on the last 10, 20 years, is this trend of outsourcing is slowing down. And so some of the one of the reasons why we're not seeing growth in non-traditional workers is because the companies feel less the need to outsource or continue increasing the number of jobs that they are outsourcing. We talked already about the impact of the tight labor market that reduces the supply of non-traditional workers. There's also a kind of more structural reasons. Many occupations do not lend themselves to non-traditional work, and at the same time, people, including millennials, their expenses are constant. Mortgage, food, or other expenses are usually happen every month, and it is not easy in such a situation to have income streams that are not constant. So we think that the majority of people would always prefer a traditional type of job where they have more certainty about their stream of income. Also, policy, especially in the United States compared to other European countries, is not really helping the growth of non-traditional workers. We'll talk more about it in a few slides. And in recent years, there's also growing scrutiny of non-traditional work arrangement in terms of worker classification and abuse of non-traditional workers, which is also probably limiting the increase of non-traditional work. So that's why we haven't seen much growth in it. Just showing the domestic outsourcing trend, you see that those are the two groups of industries that have most of the outsourcing: the administrative and support services, the blue bars, and professional and technical services, that's the gray bars. And together, one on top of the other, they consist of most of the outsourcing in the US in recent decades. We've seen that during the 90s, and if we had this chart going back further, you also in the 80s and the 70s, the share of those outsourced jobs were growing very rapidly. But since the beginning of this century, the growth is much more moderate. In fact, in the administrative and support services, there has been essentially no growth at all in the past 20 years. We're still seeing some growth in professional and technical services, especially within that group, technical and computer services. That's where we're still seeing growth. But for example, in accounting, we don't see any further growth in recent decades. So this is a very important trend, and the fact that it's slowing down is also impacting the slowdown in the growth of non-traditional workers. So Brian and Ilaria, I think one of the also hopes that we'll see faster growth in non-traditional workers in the US is the fact that in Europe this is a much bigger deal. But we see that you see here that the US is much smaller in terms of a temporary contract compared to Europe. So why is that, and can it change? Any thoughts on that?
How much time do I have to answer this question?
120 seconds.
Right, because there is 10 years of labor market studies in one chart, so I could take a long time to answer. But okay, I'll try to highlight a couple of things. So one thing is the level. Mm-hmm. So on average, in the European Union, the euro area is more or less the same. About 15% of workers are under temporary work arrangements. And so this is a number that doesn't say anything about the European labor market, because it's one area where at the European level there is very little rules, and most of the rules are national, and you can see that reflected then in the different bars for the different countries. So the level of heterogeneity in this sample, it's massive. So I want to highlight two countries, the two extremes. You can see Spain on the left-hand side of the chart, and you can see UK on the opposite side. So the British labor market is pretty much the same as the American labor market, where there is very high flexibility. And I think, honestly, and correct me if I'm wrong, there is not much difference for an employer to hire a person with a permanent or temporary worker in terms of how easy it is to fire people and how easy it is to hire people. And the same is in the UK, and that explains why there is very little temporary jobs. This is the opposite in Spain. So in Spain, there's been an injection of flexibility in the labor market that has been really high in the 90s and 2000s, but that flexibility was on the margin, in the sense that there is two groups in the labor market. There is the workers with permanent jobs, and then there is the flexible workers with all type of contingent arrangement. And so this need for flexibility then meant that for a long time employers focused on hiring workers in temporary contracts, even if they had permanent needs at the end of the day, just to save on labor market costs. So this explains, I think, the heterogeneity. The different labor market institutions explain the heterogeneity. Now, let's look at the growth. That becomes even more complicated and even more interesting, because you can see indeed that the gray bar and the blue bar, there is almost no difference between 2005 and 2017 at the EU data or EU average. Excuse me. But then I want to just point two other countries, which is the Netherlands and Germany. So these are two countries where there's been very strong labor demand in the last years, and the unemployment rate in Germany is 3 point something, and it was not this low since the 60s. So it's unbelievable. So what you can see is that in the Netherlands, in response to strong labor demand, the contingent portion, the temporary arrangements, increased, and in Germany they decreased. So that is not apparently a factor, or not the only factor for sure, that explains the demand for temporary workers where we are in the cycle. Although that explains why it decreased in Spain, because there was a big increase in unemployment. I mean, of course, we still see the effect of 2008 crisis and 2012 recession after that. And a lot of the workers that lost their jobs were temporary workers, because precisely they were the flexible ones. So if I have to summarize this, it's complicated.
It's complicated, but you did a very good job in the short time that we have for that. We have a question here that I want to... So someone is saying that our message is the complete opposite of what they heard in some conference, and that is true. The conference board, part of our job is to debunk hypes, and there has been a hype here. I think a lot of consulting companies and even people in academia have been hyping a trend that doesn't exist. So that is our conclusion from this study. There's also a question here about the impact of healthcare. So Brian, this is happens to be our next slide. Can you very quickly talk about the potential impact of the healthcare reform before we move to online labor platforms?
So the key thing is there are two reasons why the U.S. has much lower rates of temporary work than the EU. Number one is labor flexibility. As Ilaria alluded to, U.S. labor laws are much more flexible in terms of hiring and firing than the Euro area. The second is the lack of employer-provided benefits. So obviously, when you have a massive program like the Affordable Care Act designed to provide health benefits and that subsidizes lower-income people in obtaining them, it creates more opportunity in the individual healthcare market. However, we haven't seen quite the growth in terms of non-traditional work stemming from the launch of the Affordable Care Act, in part because of the controversy over the act and sort of questions about whether it would even continue to exist. So, I mean, that's been a key factor behind it. And I think in order to get more workers to consider non-traditional work, it's going to be a matter of creating programs like Senator Mark Warner's non-independent worker proposal, which would essentially allow workers to accrue benefits across many, many occupations. And so if you do not provide benefits at a federal or state level, providing them in a way that employers can get them, and employees can get them across many, many employers can help. And that could possibly unlock some of the innovative potential of these online labor market platforms that Elizabeth will talk further about now.
Thanks, Brian. And Elizabeth, why don't you explain to our audience what are those online labor market platforms? Because we have a poll question right after that, so they know what we're talking about.
Sure. I'd really like to clarify, what is it that we mean by these online platforms? And essentially, they are online intermediaries that enable workers or sellers to sell a service or a good to customers. So first of all, it's important to distinguish between the two types of platforms. One is a capital platform, where participants are selling goods or renting assets, such as selling goods on eBay, renting out their homes on Airbnb. And then the other type of platform is the labor platform, which is the focus of our research. And that's where clients and employers connect with each other, or clients connect with workers to perform specific projects or tasks. And those can also be categorized into two different types of platforms, which are the physical on-demand services platforms, which mediate local services. And that's Uber, the ride-sharing platforms, and also TaskRabbit, and other types of platforms where you can get someone to come to your home to do cleaning, to mount a TV on your wall, that sort of thing. And the online on-demand services platforms, where these are tasks and projects where the work and the payment is delivered completely digitally. And as a result, this type of work can be completed from anywhere in the world. So those are the two main types of platforms, and there are really two big takeaways from this that I want to highlight. And the first is that the physical on-demand services platforms aren't just for use by domestic households. Increasingly, some of these platforms are geared towards offering commercial services or online staffing solutions that companies can start using to start addressing these labor shortages. And then the second big takeaway is on the online services platforms that are really catering to jobs that can be performed completely virtually, and that really can be done from anywhere in the world as long as there's a reliable internet connection. So it really creates opportunities for companies to use these platforms as an additional outsourcing mechanism. So that's essentially what the platform economy is, and maybe we can transition to the poll question.
Yeah, let's, so studio, can you put out the second poll question, please? Okay, so the second poll question is, now that you know what labor market platforms are, has your company used online labor market platforms to hire workers? Not at all, experimentally, on a limited basis, frequently. So again, has your company used online labor market platforms to hire workers? So I'll give you 5 more seconds. 5, 4, 3, 2, 1, 0. Okay, so the poll is closed, and I think perhaps not surprisingly, given our study, 62% of you said that they don't use labor market platform at all. Only 3.5% are using it frequently. I think that is also the impression that we got from talking to companies. There are some other questions that are coming in, so I just want to clarify one point before we get back to the platforms. We're not saying that non-traditional work are a small part of the economy. We're just saying that they are not growing anymore or haven't been significantly growing in the past decade. There are many companies where non-traditional workers are a very large part of the company. Of course, that is the case. So going back to non-traditional work, so what do we know about the growth of labor market platforms, Elizabeth?
Sure. Can I go back to the slides?
Oh, you don't see the slides? We are now at...
Yes,
okay.
There we go. Actually, let me move this back one. Perfect. So yes, like Gad mentioned, there is a hype around these non-traditional workers, and especially the platforms. And just one comment on the millennials. Millennials are demographically the most likely to participate on these platforms, but in terms of the hype, they are using them as side gigs or side hustles. They're not the way that they're not part of their primary job or primary income for this demographic and all demographics. So that's part of the hype, that it's something that's being done on the side and not necessarily a main job. But what we can see here on this slide is the platform economy in its different segments, the ones that I had mentioned before. So we've got, for example, the transportation economy or the transportation platforms in the orange line. And this is the percent of households that have participated on these types of platforms. So we have about 1% of households are participating on transportation platforms such as ride-sharing or delivery services, and non-transportation type labor market work is very small at the very bottom in yellow. And you also see the segments for the capital platform economy, selling goods or leasing assets. That's also part of this. But really focusing on the labor platform, you see that it's about 1.1% of the workforce that is participating on platforms, and that's consistent with estimates from the Bureau of Labor Statistics that just came out with their estimates on workers that participate on work that's electronically mediated, as well as some other academic studies. It's very much in line with that as well. So what we see is that really it's transportation that's driving the growth of platforms, and the other non-transport work has really been stagnating over the past several years. So we don't see a lot of growth in there, and that's what we're talking about. It's outside of transportation, platform participation is small and is slowing. So while platforms have grown early on, we're really expecting future expansion to be more subdued than in the past.
Thanks, Elizabeth. We are almost running out of time, so I wanted to go to one more slide, because we had the opportunity to look at to classify thousands of jobs on a large online platform and classify them by hundreds of occupations. So we got a unique view on what types of jobs are being advertised on those platforms. So what are the main conclusions from there?
Essentially, what we have here is a practical starting point for employers on how they can use platforms to fill specific roles. And these are the roles that we found. So what we see are specific occupational groups that are organized by the different skill levels, and the shading relates to the type of platform. So you can have pure online on-demand services occupations that are highlighted in white, and in blue are those occupations that lend themselves to physical platforms, and then some that are gradient from white to blue can be used or can be found on both. So just one quick example, sort of those computer occupations in IT, those are the ones that are by far most common on platforms. And those programmers, the software developers that you can hire virtually from anywhere in the world, India, anywhere else in Asia, we see that type of activity going on as well. But also you can hire IT help desk support workers or network technicians to help you with your hardware, and those are physical jobs that you need them on site to help you with that type of thing, and you can find those types of occupations on these platforms as well. And the only other one I'll highlight is the sales workers, since we're nearing the retail the holiday retail season. You can hire, cashiers or retail salespeople to take on different shifts in your store, or to really take up that extra demand that we're going to be seeing in the holiday season. So that's also an option for hiring non-traditional workers on platforms.
Thanks, Elizabeth. Unfortunately, we kind of ran out of time, but we will have a full report coming out in the next 2 weeks, and another webcast just on this topic. So stay tuned, and you can learn much more about the non-traditional workers. So just before we conclude, to remind you that next month, as usual, we have the Economics Watch suite of products, including the webcast again. We'll have next month, we'll focus on our global economic outlook. Brian in Ilaria will be here again. Elizabeth and I will not take the months off. Those are some of the webcasts and publications that are coming up soon. And just wanted to thank you for joining us. If you have a minute to provide some feedback, that would be very useful. So thank you, Ilaria, Brian, and Elizabeth, for joining me today, and to our audience, have a good rest of the day.